Welcome to HIL Limited's Qtr4 and FY18 conference call for investors and analysts. Call has been hosted to discuss the financial performance and share operating highlights of the company with you. I have with me on the call Mr. Roy Chaudhary, Managing Director and CEO of the company, Mr. K.R. Veerappan, CFO, Mr. G. Manikandan, Company Secretary and Finance Controller, and Mr. Ajay Kapadia, GM Finance. We will commence the call with comments from the management team, post which we shall open the call for a question and answer session, where the management will be very glad to respond to any of the queries that you may have. At this point, I would like to highlight that some of the statements made on today's call could be forward-looking in nature and that the actual results could vary significantly from the statements made. A detailed statement in this regard is available on the company's earnings presentation, which has been circulated to you earlier. I would now like to invite Mr. Dhiru to commence by sharing his thoughts on the business model of the company and the strategic imperatives that lie ahead. Over to you, Dhiru.
Thank you, Siddharth. Good afternoon, ladies and gentlemen. A warm welcome to everyone. I thank you for taking out the time to join us on this call. FY18 has been a seminal year for HIL, where the business charted a strong trajectory underlined by volume improvement in across product segments. We were also able to seed multiple platforms for sustaining a robust growth narrative. Our brands Charminar and Birla Aircon have accessed to tremendous goodwill both from trade and the end consumers. We have been successful in leveraging the more immediate opportunities across both roofing and building solutions, and this has translated into a good increase in the revenue line during this year. Roofing has grown at 10% year-on-year, and building solutions recording a 23% year-on-year growth during this financial year. Profitability momentum has been strong, with Q4 for the year 18, profit before tax up 302% year-on-year at rupees 30 crores, and for the year 18, profit before tax up 63% at rupees 120 crores. We have seen marked improvements in business in roofing, delivering 15% increase in Q4, 10% increase for the year 18, targeting both retail and institutional segments. We have been addressing roofing market comprehensively with Charminar and Charminar Fortune brands. Charminar Fortune Green Roofing Solution has been tasked with widening the sales footprint into the institutional category. The way the pipeline has been building up, I'm glad to share that this has been a timely investment. Initial focus has been on seeding this product education, and mind share gains. Response from target segment has been encouraging, and we expect meaningful contribution from the second half of this year. At present, we are committing a single facility to the segment, but we have full intentions of backing growth as and when required. The beauty of the model is that it is relatively inexpensive to scale up, and we are utilizing the existing apparatus and capabilities. We have been pursuing product plus solution strategy in building materials, creating opportunity for long-term engagement with key customers, and that has been driving growth. We are working with builders, doing the mock-ups for them and assisting them in way of grooving inside the product for the cables and all the rest of it. Earlier, we were only supplying blocks. Now we are doing the entire solution for them and setting up training institutes with big builders and everything that is required to be together with them to give them the comfort. It's the last leg handshake, which I believe is helping this business immensely. I must also mention that the growth we have charted up for the plumbing solution business, pipes and fittings, is closer to being realized, as we operationalize plants through new product lines. During the quarter, we commenced the commercial production of SWR, soil, waste and rain pipes, pressure pipes at Faridabad plant in Haryana. Further, just recently, we commissioned SWR, soil, waste and rain pipes, pressure pipes and fittings facility at Golan, Gujarat, taking production capacity from existing 7,500 tons per annum to about 13,000 tons per annum across all units. This will further expand to 18,000 tons per annum after commissioning of the CPVC and UPVC pipes and fitting facility in Golan plant in next quarter. This is part of our plan to expand the available opportunities in the market, which we want to capture as we believe we have the right brand, the right product, and the right marketing sales network. Markets are attuned strong to Birla Aircon brand. This augmentation of the portfolio will further strengthen HIL's relationship with the trade channels, plumbers, influencers, and builders/developers. Building on our brand equity, connecting our brand to the wider customer base continues to be our focus. We recently launched first ever television commercial introducing the new positioning for HIL, Together We Build, which highlights the presence of our company in various building materials with its brands Charminar and Birla Aircon, with products for roofing, pipes and fittings, smart putty, panels and blocks. HIL's association with CSK is intended to showcase our brand to a larger audience through the ever-popular cricket tournaments. The loyalty and faith reposed by our business partners and customers in the business and brand makes us identify as champions, much like the team's winning attributes. We are confident that the new campaign will bring in a new wave of awareness for HIL and provide a fresh take to evolve the market. I am delighted to state that HIL has been conferred with India's Best Company of the Year 2017 award, as well as India's Most Trusted Brand of the Year 2017 award in the category of building materials at a recently concluded ceremony held at Mumbai. These awards have been constituted by International Brand Consulting Corporation, United States. Additionally, HIL has been conferred with the prestigious TPM Excellence Award for 3 of its roofing manufacturing plants from Japan Institute of Plant Maintenance, JIPM. These recognitions underline HIL's commitment to drive a world-class operation in the field of building material solutions. The awards are also a testimony to the dedication of the personnel associated with the respective facilities towards production excellence. Our excitement for the future is underlined by the visibility we are creating around our flagship brands. Our focus is to build on the gains in margin that we have seen year to year, and this will be the function of enhanced presence in distribution channel in the fiber cement roofing segment, the solutions-centric approach in the growing and building solutions segment, scaling up the green roofing solution product, and the momentum we are creating in pipes and fitting by way of enhancing the product range and market reach. Our true strength is in our committed and efficient employees, loyal stockists, and our strong corporate governance and value system. It is this vigor within the organization that enthusiasts me, and I'm confident that we will be able to deliver consistently good set of performances in the coming period through the articulated objectives. Last but not least, I'm happy to share that the board has approved a final dividend of rupees 12.50 per equity share for the year 18, and thus making total dividend payout of rupees 22.50 per equity share for the year. Thank you very much for your patient hearing. I would now like to invite our CFO, Mr. Veerappan, to take you to the forum to share this his perspective on the financial review.
Thank you, Dhiru. Good afternoon, and thank you all for joining us on the call today. I would like to inform that this is the first year of adoption of Ind AS reporting standard, and I'm thankful to my entire team who helped us to publish the results in a very short span of time. I'm also happy to inform that HIL is the first listed company in the industry to have accomplished this task. I will now start by recapping the financial highlights for the quarter and full year, and then focus on providing you some flavor around the numbers and our journey forward. The sustained growth can be witnessed in the revenue, EBITDA and profit, and this be duly complemented by a much leaner balance sheet. In FY18, revenues stood at rupees 1279 crore as against rupees 1119 crore in FY17, thereby registering a growth of 14%. In Q4 FY18, revenues grew by 22% to rupees 335 crore as against rupees 274 crore in Q4 FY17. Please note, for the purpose of comparison, total revenue and total expenditure are shown net of duties and taxes on sale of goods. 15% year-on-year growth realized in the roofing segment in Q4, which delivered growth for the third consecutive quarter, leveraging the increasing Chamina brand equity. Strong contribution continues to come from building solutions, with 27% year-on-year growth in Q4 and 23% year-on-year growth in FY18. This performance has been driven by a strong brand recall for Birla Aerocon in combination with our solution-based approach. In FY18, EBITDA stood at rupees 171 crore as against rupees 127 crore in FY17, an improvement of 35% year-on-year. In Q4 FY18, EBITDA grew by 120% year-on-year to rupees 42 crore. I am happy to state that this year we have registered highest ever EBITDA in the history of HIL. EBITDA growth is in line with broad-based gains in revenue line. Expansion in product and customer metrics is opening up opportunities for further leverage in margins. The sustained improvement in EBITDA performance is underlined by disciplined cost optimization measures. In FY18, PBT improved by 63% year-on-year to rupees 120 crore as against rupees 74 crore in FY17. In Q4 FY18, PBT improved by 302% year-on-year to rupees 30 crore. This performance has been supported by growth in sales across board. Judicious capital allocation, complemented by initiatives to enhance enterprise productivities, is setting the stage for superior returns. I am pleased to share that the balance sheet continues to be strong. Net debt to equity remains at 0.12x as on March 31, 2018 versus 0.12x as on March 31, 2017. We have zero interest-bearing debt for the past 2 consecutive years. We have further aggressively optimized working capital intensity by focusing on all parameters, which has resulted in net working capital reducing to 4% of total revenue as against 12% of total revenue in the previous year. As our business mix continues to transform, a foundation is being created for an even better performance in the coming period. On that note, I conclude my opening remarks. We would be happy to give you our perspective on any questions that you may have. I would request the operator on this call to open question and answer session. Thank you.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take the first question from the line of Rajesh Kothari from Alpha Accurate Advisors. Please go ahead.
Good afternoon, sir, and congratulations for a good set of numbers. Just a few questions from my side. If you can give us what is the volume growth of both the segments, roofing solution and building solution, for the fourth quarter and for the full year? Question number 1. Question number 2 is, can you give some color on raw material side of the business? Is there any price inflation on the raw material side? And third is, if you can a little bit brief us on pipe business, business update on the same.
Thank you, Rajeshji, for asking this question, and thank you for being in the call. On the quantity side, in Q4, we have grown the AC sheet business by 12%, and that brings us to the annual growth of 6% for this business on quantity. On the building solution side, we have grown by 9% on AAC block and 19% on panels in the quarter 4. That brings us to 5% growth in AAC block cumulated for the year and 17% growth on volumes in panels for the year. Your question was on raw materials. We have absolutely no problem on the raw materials. We have fantastic connections with our suppliers, and that's happening hand in hand as we speak, and we see no risk on that account at all.
My third question was on the pipe business, if you can give some business update on the same.
Yes, so the pipes business, as we said in our opening remarks, we have already commissioned the Faridabad expansion of SWR. We have also, just a couple of days back, commissioned our Golan new plant for the SWR pipes and fitting. The CPVC and UPVC pipes and fitting business expansion in Golan is in the process, and we should see that getting commercialized by the end of the quarter. The pipes business has grown by 21% on revenue over last year, and we definitely believe that we have got the right technology behind the product, which has made the product to be an excellent quality, as has been rated by experts in the market. And we are doing a lot of branding activities to get the brand pull under the name of Birla Aircon. And we are expanding our sales and marketing network by the day. And we have absolutely no concern in way of expanding this business this year as we talk.
Thank you, sir. Thank you very much.
Thank you, Rajeshji.
Thank you. We'll take the next question from the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead.
Yeah, thank you for the opportunity. Sir, I wanted to know the broad mix of the building solutions business, because there are many sub-products. If you could give some broader idea as to what percentage would be pipes and, what percentage would be panels.
So the building solutions, thank you very much for your question, first of all. The building solutions business comprises of the wet walling solutions, where we talk of AAC block and building motors and putties. The dry walling solutions, where we talk of the panels, the boards, and the smart fix. And the pipes business is separate. It is in the others business. It is not with the building solutions business. On way of the contribution for the business, the roofing segment contributes about 64% of the total business. The pipes and fitting is small at this moment, only about 54 crores, and the balance is building solutions, which makes up the total volume.
I wanted to know within building how much is wet wall and dry wall.
So, we have that number with us. Yeah. Just give me a minute, please.
And at the EBITDA level, what is the EBITDA mix between building solutions and roofing solutions?
Okay.
Okay. As far as the EBITDA is concerned, for the year, roofing solutions, out of the total 170 crores of HIL, roofing solutions have delivered around 154 crores, building solutions 36 crores, and the balance others, and there are unallocated expenses of 32 crores. So that comprises of the total 170 crores of EBITDA. If you see in terms of percentage EBIT margin, it's
I have that number, EBIT. So the 170 is split up as 154 for roofing and 6 crores for building.
36 crores for building, 36.4 for building solutions. 154 roofing, building solutions 36.4, others 12.6, less unallocated expenses of 32.3.
Plus 12 and allocated
32.3.
It is at the EBITDA level.
Yeah.
Okay.
You want at the EBIT level?
No. I have at the EBIT level. Also, I wanted to check, FY18 has been a fairly strong year on roofing, both in terms of volume and margin. I understand probably the margin could also be a function of, asbestos fiber being imported and currency being favorable and cement price also being lower. So what would be your assessment on the margin side of the roofing business and the volume growth? Also, this business works relative to steel. So whenever steel is pricier, asbestos finds favor. So slightly on a 2 to 3 year perspective, what would be your call on the roofing side, especially asbestos, on growth and margins both?
Thank you again for this question. So we have been extremely encouraged by certain government policies which have supported our business. We had the demonetization just before the beginning of last financial year, which consolidated itself in the Q1 of this year. And then we had the GST implementation, which had the initial hiccup in way of stocking, but thereafter we see an immense benefit to the business in way of consolidation in the market, transparency, as well as a 10% reduction, which has been passed on to the customers that makes the business more viable for the customers. Steel prices went up, and that has helped the business because the immediate competition to our product is from the corrugated steel suppliers, color-coated steel suppliers. Yes, fiber has been an advantage, definitely, but that's also because of the 70 years legacy that we have and the connect that we have with the fiber manufacturers. So we definitely draw a premium over the rest, I would believe, so far as the costs are concerned. Our product is extremely professional and has the lowest breakages and highest quality, and therefore as a brand, Charminar stands above the rest with the highest market share of close to 21%. We have grown that market share slightly this year, and we get a premium from the market, and as the market grows, most of our capex are depreciated because of the long association that we have in the business. And definitely with the volume growth, the entire thing flows on to the profitability, and therefore a good business on roofing means a good profitability automatically coming through. We have also launched this year a fantastic product called Charminar Fortune, and that's a non-asbestos cement-based corrugated roofing sheet, which is autoclave. We have done the IP around it. We are the first, we believe, in this world to have come out with this product, because the other people who have a non-asbestos cement-based roofing use a different technology, which is, we would say, not as good as the one that we have from Charminar Fortune. This business is just about stabilizing at this moment. We are seeding it in various institutional customers. We want to take the bite from a market which we were not present, which is the institutional segment, the big government houses who went away from asbestos in 2004 or 5, and we believe that this would bring in a huge sense of expansion for the group as we go forward in the coming months.
Question was actually, sir, you foresee...
Sorry to interrupt, Mr. Chheda. So we're not able to hear you.
Okay. My question was, sir, do you foresee what kind of growth in roofing, and are these margins elevated or these margins are sustainable and you have got some benefits on what prevailed in RM in FY18?
No, I don't think these are elevated by any means. These are quite sustainable margins. We have pruned down our expenses to a great extent and improved our own operational excellencies. The market is showing up. There has been good monsoons, and the waiver of the loans with the farmers are supporting the cash flow with the farmers. I think this year also would be a good. The traction should continue.
Okay. And what kind of growth is possible in building solutions?
The tractions are doing well, and I think we will catch up. So in building solutions, we are doing the solution-based, and that should support us in way of growth in building. I think what you have seen this year is something which is sustainable, both from growth as well as profitability point of view.
Thank you very much.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, please limit your questions to 2 per participant only. The next question is on the line of Qtr4 from Rare Enterprises. Please go ahead.
Yeah, hi. So could you please explain the opportunity size from the institutional market for this green roofing solution? Also, the sustainability in demand for the long term.
Qtr, thank you very much for your question. So this is a completely green field for us because we have vacated that segment long back, more than 1.5 decades. I believe the roofing segment market in institution is far in excess of 4,000 crores, but they are also investing in the Pakka roof, which is the RCC. They also buy steel at this moment. And therefore, we definitely see a good opportunity to come in there with a much more sustainable product, which is the Charminar Fortune. As against steel, it is high advantageous product, high life, long life. Steel, I would say, is 8 to 12 years, and this is a lifetime product. The thermal insulation, the sound insulation, all of it stands very heavy in advantage to Charminar Fortune. So we definitely see that this would be revolutionizing both the industry and HIL's performance going forward. Sustainability, of course, this is a product which is of high sustainability and high strength with very minimal breakages, and I think this product will definitely stand out in the institutional segment.
What's the pricing differential for these green roofing versus steel?
So at the moment, the steel is the only one which is being supplied. So we don't have a real solution in India for non-asbestos cement-based roofing, and therefore it's a very good opportunity for us to position this product higher than the asbestos sheets around the steel sheets prices and get a good realization there.
And your main raw material is crude?
In raw material is very much indigenous. It is continues to be cement fiber, and we are replacing the asbestos with another product, which is well known by my R&D. Even I don't ask that question.
Okay, and on this AAC block segment, what's your long-term plan or vision? And in terms of competitive intensity, what is really stopping leading cement players from dominating this market in the long run?
I think it is the technology, Qtr. It is easy to say we will implement the machines, but the way that we have been able to handle this business in the last 10 years is exemplary. We have been able to come out with the best, lowest, breakages, high-strength product, very light, and all of that stands out. So today, if you go to the market and ask for AAC block, they talk about Aerocon block or Birla Aerocon block because that's the kind of assertive positioning in the market that we have been able to gather. This business is good for future. There have been lots of mushrooming of unorganized player in this market, but very soon we will see that consolidating. We are already seeing signs of that. RERA Act was a severe, immediate headwind that came through last year, but I think over the next couple of quarters that should stabilize. New buildings will come up in a big way, and all of that will definitely grow this business potential. We will wait for the right opportunity to get our net sales realizations up for this business. As the consolidation happens, that is bound to happen, and then we would make further investment into this business. This is a very good product that we have.
So you're currently running at close to full, 90% plus capacity utilization. So what's your plan in terms of growth of the segment is so,
So, honestly speaking, we are not in a hurry to set up another plant, which we can do any day. This product can only travel 200 kilometers from wherever you manufacture, and that's some restrictions that we have by way of its freight costs. But what we are doing is to grow this business, we are going through the solution route. And I think in my notes, I did talk of the kind of intensive focus that we are doing in way of being together with the builders and the customers, developing their capabilities, doing the augmentations in our product by way of what they require, and providing the whole solution, including putties, that is definitely enhancing both the top line and in a big way the bottom line. So I think at this moment, as we speak, that's exactly what we have in our mind. till the market really consolidates, the NSRs goes up, and then we will go focus. You had asked a question why the cement players are not in this business.
Yeah.
I think I answered.
Yeah, right. Ultratech and JK's in this business. So they have the technology to, they've got enough cash in their hands to, these big players to, and they've got access to fly ash. So what's stopping them from, dominating this market in the long run?
I think they've tried. Without naming, one of the big cement players did try supplying AC block, but they were not competent enough to develop this technology in the way that we have done. So there were huge breakages, there were losses with them. I don't think this is their focused business in any case, and we are very happy to be in this space where we find this to be our focused business, and we are doing well for it.
Okay, so you are currently at about 20-25% market share in this business?
So there is about 50% of the market which is unorganized, and therefore
50%.
Getting a market share would be a very difficult task, but we are leaders so far as the organized sector is concerned.
What about Buildtech and Magic Reed? Isn't Buildtech the leader in terms of market share?
I would leave that to you to assess. I would not talk of any of my competitors, but honestly, I think we are doing the best.
Okay, so just last question. Could you name your four top...
Mr. Bhuvna. So may we request that you return to the question queue?
Yeah, okay, yeah.
Thank you. The next question is from the line of Dhananjay Mishra from Sunidhi Securities. Please go ahead.
Yeah, good afternoon, sir.
Afternoon.
Congratulations for the strong all-round performance. Sir, could you explain in this quarter, what led to such a strong number, especially in roofing side, and also what were the tailwinds which led to such a strong margins?
Shraji, thank you again, and thank you for following us regularly. I think what we did different in Q4 is more a brand pull by way of a lot of activations amongst our dealers and retailers using the CSK bid that we have. So they are very excited to meet up with the players. They are very excited to watch a match in the VIP counters, and all of that helped us in drawing them towards enhancing their own results and thereby enhancing our results. So I think that was what dominated Qtr4 for us, and we are very happy about these numbers. I think overall the company is well focused to channelize its cost base to be as down as possible and enhancing efficiencies in every angle. So we have been competing within plants to enhance the capabilities of each plant and bring it up at every level. And all of that has helped in a big way towards reducing the cost, enhancing our profitability.
So could you give the absolute number for this volume figure for Q4 as well as FY18?
Yes, absolutely. Vidappan, please.
Yeah, as far as the AC sheet sales are concerned, in Q4 we have done 185,777 tons against last year same period 165,920. And as far as AAC blocks are concerned, we have done 196,189 cubic meters against 180,599 cubic meters last year. Panels, we have done 17,971 tons against 15,095 tons last year. So this is for Q4. If you want full year number, I can give that also.
Yeah, full year number is given, they provide for sheets, fiber sheets.
AC sheets are concerned, full year number, we have ended up with 7,69,831 against 7,23,984 last year. And the AAC blocks, we have ended with 7,02,593 cubic meters against 6,71,312. Panels, we have done 64,492 tons against 55,102 tons last year.
Okay, sir. And so lastly, if you could provide the capex figure for this this pipe segment we have done, and what kind of capex we are envisaging for next year?
I think, Virup, in the last quarter also we had mentioned that we are putting in excess of 100 crores. A part of it for SWR pipes and fittings in both Faridabad and Golan has been capitalized now. The balance will be done in the next quarter.
So 130 crores for both the plant, right?
Yeah, both, no, 130 included even the Chennai plant. We are also, there is a third also in the progress. So we can take it as excess of 100 crores. So we have done around 40 crores right now. The balance will be spent in this quarter.
So current capacity for this Golan is 13,000. That will increase to 18,000 by next quarter.
The total capacity is what we said, from 13 to 18,000 once we have completed the
That includes this SWR also?
Yes. Yeah, that's right.
Okay. Okay, sir. All the best for the future.
Thank you, Mr. Mishra.
Thank you. The next question is on the line of Arjun Singhal from Reliance Mutual Fund. Please go ahead.
Good afternoon, sir. That's a great result. So as you highlighted, you reduced your working capital from 12% of sales to 4% of sales, which is great. So can you please tell us what are the key measures you took to make the drastic reduction, and is this sustainable?
Thank you, Arjunji, for your compliments. Yes, the company really has worked hard towards it. Working capital is something which is well within our hands, and I think that's something that we realized much earlier, and we have worked very hard this year. Some of the old receivables that were sitting on our books were not getting collected is something we focused in a big way, and we have tried to reduce that part of it. We have also tried to prune down on further relaxation of financing capability that we give to our customers in a big way so that we are not able to land up into similar situations going forward. We have reduced our inventory in a big way because something was, as a legacy, we were following it, and I think as an organization we sat together and tried to work towards it. We have improved on payables a little bit, and all of that together has helped. Your question on whether this is sustainable or not, for the present business, yes, but as we are ramping up newer businesses like pipes and fitting and also going for charming our fortune with institutions, I think this working capital will go for a little bit of an increase, but we will continue to monitor it at the highest level and see that we do not go anywhere wrong on this.
Sure. And so finally, you had other income of about 8.4 crores in this quarter. What is the breakup of that?
It's one particular line. One particular block.
Yeah.
We had a particular surplus land in one of the depot premises, so which has been sold. It's just one transaction.
So that would be this complete 8.4 crores, most of it?
No, in that, major will be on that 3 crores. There is a dividend income for whatever mutual funds investments we are doing, that will be around 2 crores. And you're talking of Q4. I'm giving this number for Q4 actually.
Yeah, only Q4.
Q4 में the profit on sale of fixed assets was around 3.34 crores. The dividend income was around 1.9 crores. And we have certain rental incomes for our properties. It's around 1.6. And that's it.
Sure. All right, sir. Thank you very much and best of luck.
Thank you, Arjunji.
Thank you. The next question is on the line of Rishabh Chaturvedi from Edelweiss. Please go ahead.
Hello, sir. Congratulations on the good set of numbers. I have one question. That our gross margins were down 400 bips. So I would like to understand where has the margin reduced from and whether it's from roofing solutions or building products, and what has impacted these margins. Hello?
Yes. Just give me a minute, please.
Yes, sir.
I guess the gross margin reduced is the question that I'm trying to hunt on, because our EBITDA has improved. Where did you get that number, sir?
So in value terms, the gross profit has improved from 155 crores to 178 crores. But in percentage terms, it has reduced from 56% to 53%.
On the EBITDA side, I think as an organization, we have improved from 126 crore last year to 170 crore.
I'm not getting where you are. See, in terms of EBITDA margin, if you see HL Q4, we have delivered 12% compared to the like-to-like quarter, 7%. On a full year basis, we have delivered 13% compared to 11% last year. So I'm not sure where exactly.
So I'm doing revenue minus cost of goods sold. The revenue this quarter, last quarter was 274 crores, and the cost of goods sold were 119 crores. And for this quarter, the revenue was 335 crores, and the cost of goods sold were 157 crores. So then I got the gross profit, and then I put it in percentage terms. So as a percentage of sales, it is decreased from 56% to 53%.
So we will get back to you on this if you're okay.
No, I think you need to reduce the excess duty part because of the India's grouping. There is some confusion. If you go to the different ones, I don't think there is any problem there. And a little bit in terms of the business mix, overall, the percentage may be on the higher side. But anyway, we'll come back to you on this.
Fine, sir. Okay. Thank you.
Thank you. The next question is from the line of Vinay Menon from Centrum Broking. Please go ahead.
Hello.
Hello.
Hi, sir. Yeah, just one question from my side. So the number of trade payables has been increasing for the last 2 years. Any specific reason for that, sir?
Well, as I mentioned in my opening remarks, we have a fantastic relationship with our suppliers, and this is a 70 years legacy. So we have been trying to use that relationship wherever possible to expand it. So I think it's that relationship which is helping us. This is pretty much continuing.
Okay, so should we assume this kind of run rate for the next couple of quarters?
Yes, this is consistent.
This will be sustainable.
Okay. Thank you, sir. Thanks a lot. Okay.
Thank you. We'll take the next question from the line of Jigar Shah from ICICI Securities Limited. Please go ahead.
Thanks for the opportunity. Sir, I wanted to ask the question on boards and panels. What would be the installed capacity for the same?
Thank you, Mr. Shah, for asking that question. We are doing about so on boards and panels, we are
See, the panels, our capacity is around 72,000 tons per annum.
And boards?
Boards, we are basically focusing as a facing sheet for the panels. So we are not focusing on boards as a market individual. About 20,000 metric tons, you can say, as the board's capacity.
Okay, so you are very close to the capacity. I mean, you did some 65,000 panels, right?
55.
And you're growing good in panels, like good double digit. So my question is that, and will your EBITDA margin will be higher in boards and panels than AAC blocks?
Yes, that's right.
So is there any plan to grow in panels where you are growing faster and good EBITDA margin? AAC blocks not doing well since last 3-4 years. Your margins in single digit, if I'm not wrong, in AAC blocks?
You're right.
So what is the plan going forward in building solution?
So, Mr. Shah, very, very good question. I must compliment you for this.
Yeah.
I had answered this last quarter, but I'll do it again. You know, the entire boards market, as I see today in India, is about 400 crore for the material that we manufacture and similar to that. And therefore, this is not a focused market as of now for us, because if we want to expand, the capex is normally 150, 200 crores for additional board plants. And if we do that, we should be very clear that we'll be able to have the necessary asset turns around in this business. We are studying this market, as I speak to you, in detail. And if we feel that there is a need to expand this, we will definitely do this. But it's a very, very good question that you have asked.
Okay. And one more question is this, other income of 8 crore, is this sustainable or just one-off?
So rental income is sustainable, which is there, of course. But sale of land is one time, so it keeps happening as and when there is a surplus land. We have a land bank in the organization, and when there is a surplus, it happens. Dividend income and rental income will continue. That's it. Till we invest the money elsewhere.
Okay. And one more thing, boards and panel contributes how much of the revenue?
Boards and panel together is about 65-70 crores out of the total revenue.
65-70 crores. Okay, thank you.
Thank you very much, Mr. Shah.
Yeah, thank you.
Thank you. The next question is from the line of Samrat Sangvi from Phillip Capital India Private Limited. Please go ahead.
Good afternoon, sir, and congratulations on a great set of numbers. We've been seeing that coming up across the last 3-4 quarters now. Just wanted to ask, sir, pardon me if I might have missed it in the beginning, any update on the plans that we would have in terms of our acquisitions or anything?
Samratji, acquisition was only something which we had referred earlier, as we are open for it because we have a clean balance sheet and a cash in account. That's not the focus that we are at this moment doing. In any case, last year was the first year for me in this organization, and there was a lot that we thought internally that we could achieve. And thankfully, thanks for your compliments. I think we have, as a team, been able to deliver some robust number. We would like to focus in our existing business while keeping our eyes and ears open for M&A. And when anything crystallizes around that, you will get to know about it.
All right, sir. Thank you so much for your time, sir, and all the best for the future.
Thank you. The next question is from the line of Siddhar Rajpurohit from JHP Securities. Please go ahead.
Good afternoon, sir, and congratulations for a good set of numbers. What will be the share of unorganized...
sorry to interrupt, Mr. Purohit. Excuse me, sir. So we are not able to hear you clearly.
Hello, is it clear now?
Better. Thank you.
Sir, good afternoon.
Good afternoon.
So what will be the share of the unorganized market in the roofing business?
So the roofing business is primarily dominated by a few organized sector. I would say about 10% would be unorganized. Otherwise, everything is organized.
Okay, sir. And we have mentioned in the call that we have captured market. So after market share increase, if we are grown at 5%, so can we assume that the industry is growing at 3-4%?
Yes, you can assume that, sir.
Okay. And what will be our key markets, sir, with regards to roofing? And also if you can mention the key demand drivers?
I think roofing, I mentioned to you the key. Let me take the second part of your question first. The key demand drivers for roofing is, the monsoon is always followed by the next year's demand. So if there's a good monsoon in one of the years, the next year there's a good demand driver. That's one of the KPIs for driving this. The second is we have been benefited by way of GST, which has reduced the taxes from 28 to 18 and made it this product more viable for the consumers, and that has helped in the business full. The third is we have got the waivers of the loans at the farmers' end, which is definitely supported in way of cash flow for them. And all of these are positively impacting the business, and we hope that the traction continues in this direction. For the way of spread, I think we are spread pan-India completely. We have 6,500 strong stockists first level, who are most of them serving us in the third generation. And we have a price premium over the rest. We have a brand which is par excellence and a lot of brand pull, and everything helps us to sustain this in pan-India basis. We are strong in one or two zones. We are slightly low in one or two zones. Again, it depends on where our plants are located and where our focus is. But overall, you would say pan-India, a full strong brand of Charminar.
Okay. And in roofing business, is there a lead distance which we can go from the plant?
No, in roofing, honestly, the product is so robust that the breakages are less than 1% as against 4 to 5% average in the market for all other products. We have sent this product 2,000 kilometers and it has sustained very well. I don't think there is that limitation, but definitely the freight cost would have an impact on the total cost base, and so it is more commercial than technical.
Yes, sir. I was on the commercial side only. Means how, to what extent we are viable or competitive from the plant if we...
So we have 6 factories around the country and we are quite spread that way. We are slightly less in the deep south, I would say, and that is more strategic because we feel the demand there is sliding a bit. At this moment, I think we are well versed in all the other zones except slight weakened south, more from a plant perspective, but otherwise we are very well positioned. Yeah.
Okay. And so in regards to branding, sir, what would have been the branding cost for this quarter and going forward, how it will be? Sir?
So the branding cost hasn't increased immensely at all. We had mentioned earlier that we expect that the branding cost will go up by 1%, and we are well within that. And we are prudently using our money in branding, and we have got a new marketing head to drive this efficiently for us, who has an experience from Jio and from Airtel. And I think what we are doing is prudently using all the money for very clear channels to make our brand very viable.
So any percentage of sales that we have done and we are targeting?
I said about a percentage would be more than what we have done on revenue base.
No, but as a percentage of sales, what will be the branding expenses?
We are still in the process of capturing all the data. Maybe next quarter we would be able to have a better view.
Okay. Thank you, sir. I'll come back in again.
Thank you so much.
Yes, sir. Good.
Thank you. The next question is from the line of Ritika Garg from Equitas India. Please go ahead.
Good afternoon, sir. So could you tell me the industry growth rate for roofing segment?
Ritika, the industry has been growing about 2 to 3% last year, and we expect the same growth to happen this year. The traction is good.
Okay. And so with the rupee depreciating, we import our raw material, the fiber, right?
Yes, that's right.
So do we see our raw material costs going up?
So definitely, Ritika, the fluctuation of rupee dollar does impact, but what we do is we never take an open exposure, so we always go for a very close rupee dollar monitoring, and so I don't think that will have an impact on our cost because we do that very well. The hedging is done extremely well in our organization.
Okay, and currently our sales mix is around 60% is roofing, around 33% is building solutions, and the balance is others. So how do we expect to change the sales mix going forward?
So, thank you, Ritika. Again, we are about 64% in roofing, I guess, if those are right. What I would suggest is, what I would say is, as we grow in the newer product, which is pipes and fitting, as well as Charminar Fortune, this mix would keep changing. So we don't monitor it as roofing and non-roofing. We rather like to monitor as asbestos and non-asbestos, and we would definitely go on expanding our non-asbestos portfolio while still growing in the asbestos product.
Okay, but then so most of our EBIT or most of our margins are contributed by the roofing segment. So then we would naturally see the margins coming down going forward?
I don't think that's the right assessment. You see a good margin in roofing because we are historically a roofing solution provider. So that's been our deep strength. Most of the assets are depreciated, and that's what you see. But pipes and fitting is a very profitable business. Most of the leading players are doing very good on both EBITDA and ROCE. We see that particularly supporting in this direction. And Charminar Fortune would be an exemplary product once we are able to establish it in the market in a big way, which will give higher profitability than the present profitability from the roofing sector.
Okay, how much revenue do we expect to get from the pipes and fittings business in FY19?
So, I had said sometimes back that we have very high aspiration on pipes and fitting, and we want to grow to 350-400 crore in 4 years' time, and I think we are well on way for that.
Okay, and margins typically for pipes would be?
This is, at the moment we are still in a very primitive stage. We are only 50 crore in the volume, but as we stabilize this business, the margins will be as good as the company's average.
Okay, thank you, sir.
Thank you.
Thank you. The next question is from the line of Megha Hariramani from Pi Square Investments. Please go ahead.
Yeah, thank you for the opportunity. Most of my questions been answered, but just one highlight, if you could just give us on the geographical revenue breakup, how much does each of the region contribute to the overall revenue?
So, Megha, I think I mentioned this earlier, but thank you for asking this again. Now, we are pretty much in every zone, so except south, a little bit down, otherwise it's quite average in all the other zones.
Any focus area for us for pipes and fittings, which is the new division coming up? Where do we want to, enhance our presence for that product?
We have 3 existing plants now. We have one in Hyderabad, one in Faridabad, and one in Gujarat. Golan is the area. We will also have a pipes and fitting plant in Chennai very soon as part of this expansion plan. And the freight and F&I costs for these products are not very exorbitant, and therefore these products can be sold to any part of India from whichever plant we want. So I don't think we will have any kind of constraint on the geographical push. We want to be pan-India on this. Hello?
Sorry to interrupt, sir. The line for the current participant has dropped off. We'll move on to the next question. That is on the line of Charandeep Singh from Girik Capital. Please go ahead.
Yeah, hi, sir. Congratulations on a really nice quarter.
Thank you, Mr. Singh.
Momentum. We have one question on the balance sheet. What was the cash balance and the marketable securities balance combined by the end of the year?
As of the mutual funds investments are concerned, it was around 120 crores.
Okay, so the total cash accrued year over year was approximately 100 crores, right?
Yeah, this is the first year, one of the first, okay, I have not mentioned in my opening remarks, and I'm happy to share that this is the first year where throughout the year, every month, we have been having 100 crore plus surplus.
Okay. Another housekeeping question. On other revenue is reflected at approximately 70 crore. Of that, pipes and fittings, I think you mentioned is 50 to 55. What is the remaining revenue?
Well, we do generate an income from windmill operations. So that's around 7 crores.
Okay. How much capital is allocated there?
What's your question?
Yeah, how much capital is allocated in that windmill operation?
Net blocks will be around 40. We have around 6 windmills across the country, around 40 crores of revenue.
All right. Okay. The rest of our questions are answered. Thank you so much.
Thank you, Mr. Singh.
Thank you. The next question is from the line of Sanjay Satpathy from Amarsan Capital. Please go ahead.
Hi, sir. Congratulations on a good result again. My 2 things. You mentioned that industry will grow by 2-3% in fiscal 18 for roofing. And what is the growth that you are looking for there?
So, Sanjay ji, we are already the market leaders there, and we have, as I mentioned, about 21-22% market share. And this is quite a matured market, and therefore growing market share is significantly difficult here. To retain the market share is our concern, because any new player which walks in tries to eat away the market from the leaders. So we'll be happy to maintain our market share, if not grow it by a few decimal percentages, but we hope that this market will continue to grow and grow better.
And in terms of your pipe business, what kind of size or revenue growth you are looking for?
So I did mention this, and I'm happy to repeat that, Sanjay ji. We have a good feel about this because we have a great product in hand, and we are hoping to get this business up to about 350-400 crore in the 4 years' time.
And you have already completed the range of products which you were looking for in the past.
We are continuing to add on our product profile, but we are very much compacted today.
Thanks a lot, sir.
Thank you, Sanjay ji.
Thank you. The next question is from the line of Rajesh Ravi from Centrum Broking. Please go ahead.
Yeah, hi, sir. Good afternoon, and thanks for this call. I have a few questions. First of all, regarding this roofing business, we have done industry-leading growth of 6%. If I see the revenue growth for this business, it seems, on a net sales adjusted basis, I see around 12% revenue growth. So have we been able to see a better margin improvement, revenue realization improvement in this segment?
So, Rajesh ji, you are absolutely right. For us, the improvement of revenue is more from a point of very, very consolidated business that we have here, where the product mix, the regrouping, the geographies that we supply, all of that has a lot of implication on this business. So we have tried to look at every bit. We have reduced our, point of go downs, and we have brought it down from 57 to 40. All of that has a good impact on the realization.
Okay. That's nice to hear, sir. In this, so from this business, what utilization we are operating and the volume growth, can we expect that it could be around 5% for next 2 years, assuming things remain stable as they are?
So this business, if you are aware, is a little bit cyclic, and there are some peak times when, we say between March and July middle is the peak time for this business. So our plants are 110% full during those times, and then there are a bit of a slack periods when our plants are not fully loaded, and we use that for the purpose of maintenance. Now we are using the off-seasons for the same plants. We are using them to make Charminar Fortune, which is the new non-asbestos product we have come out with. And therefore, we are about 70% utilized in the manufacturing capacity that we have. We have in excess of 1.1 million metric tons that we can supply. And therefore, there's enough capacity to contribute to this 5% growth or whatever you are talking about.
Okay. That's great, sir. And this Fortune product, obviously it's in a testing phase, but in terms of your cost metrics versus the, AAC blocks which you are producing, are they similar or the cost is, slightly higher, even at, ex-factory level you're costing? I understand that for this single plant you would be supplying to various, so freight cost will vary. But even at ex-factory level, how is the costing experience that you're seeing, sir?
Ajitji, it is at this moment in a very primitive state. So if I say that the cost is high, it won't be the right reflection of how it will be in future. You please allow us to take another couple to stabilize this product. It will be slightly higher than our existing asbestos roofing segment, but the market realization would also be higher. So I don't think the cost will have an impact on that.
And once, because in your earlier con call also you have mentioned that the institutional market which this industry has lost out to metal roofing sheets can be a big opportunity for such products. So once if this product acceptance is good and your capex intensity for converting the lines, could this become, many of your other lines would also get converted into, this non-asbestos roofing sheets? Is that a thought process?
You're absolutely right, and I think you have taken it out of my mind. This is exactly what we want. We want to expand this product more and more as we get it seeded and accepted by the customers. As you rightly said, the customers we are testing today is with the institutional segment. Big customers who have their own norms of approving materials, first getting them into their approved list, and coming and testing the factory, testing the product, using a small quantity to test it for the next 12 months to see how it works. So there is a certain set rules that are there with these big customers. So we'll have to be slightly more patient here. But you see, everything today is giving us a very good count that this product will sensibly build up to a very big business within HIL in the coming years.
Okay. Great, sir. And this building solutions, if you could just throw what sort of growth opportunities, because AC blocks, we are at peak and we would be waiting for more capex in that business. And obviously the solutions building up, primarily the boards and panels where most of the growth would come from in that segment. And thirdly, the pipes business, if you could throw what sort of investment when we are talking of a 400 crore sort of top line, fixed capital investment and working capital investment that would go through, if you could throw more light on that. And also, if possible, to, articulate what sort of top line we would be looking forward to, not really, in a more broader number for FY19 and 20 from the pipes and fitting business.
Ajitji, you virtually asked me the entire P&L and balance sheet. I'm happy to answer in a short way, but I'll be happy to meet you up in case you have any other questions remaining. On pipes and fitting, I said 400 crore, 350 crore is our aspiration in the next 4 years. We are very much aligned, and the capex that we are investing presently would lead us towards that. So I don't think we'll be having any major capex invested for reaching those numbers. But our aspiration will not limit ourselves to those numbers, and therefore, as and when we feel necessary, we will invest more. We have cash in our balance, and there is absolutely a good use for it if we go for pipes and fitting as the business grows. Your question, the other question was on building solutions. So building solutions, we are very much happy to go the complete systems route, building the complete solutions provided to the customer, because simply adding another AC block plant we don't see is the need. There's a lot of consolidation happening in the market as I speak. Any day there are a few requirements on the table for M&A, buyouts for AC block plants, and therefore people are selling them. There is a market consolidation happening. Demonetization has pumped it through, plus GST transparency is pumping it through. This market had a lot of gray area, which is now settling down. I think we will give it another quarter to really realize the real value add from this business before we pump in any further money.
Okay. That would be great, sir. And lastly, on the pipes, what sort of working capital is similar to what you're currently doing, or is the working capital requirement would be, different, structurally different from the current business mix on a blended company basis?
Net working capital is not a consistently viable solution for newer products. So there'll be some requirement to pump in definitely on this. But as and when the business happens, I'm sure this will be something we will look at. It won't be a very big difference.
Indeed, sir. Great, sir. Thank you for taking all my questions. Thank you and all the very best.
Thank you. The next question is from the line of Umesh Patel from TCG Asset Management. Please go ahead.
Yeah, first of all, congratulations for excellent set of numbers. Sir, my question was related to PVC piping segment. As you have drawn down, your vision to, achieve 400 crore of revenue from 51 crore. Wanted to know a few things, sir. Okay, what is your game plan in terms of, new distribution, new distributors to be added in FY19? What is it? And in terms of, pricing, wanted to know where your company stands in terms of pricing when it comes to your competitors.
So, Patelji, thank you for asking this question and being on this call. This is definitely our focus business, and we would love to see it, travel throughout. We are definitely looking at building new distribution channels, working with MEP consultants in way of introducing our products to big builders, and also working at the last leg with the plumbers and trying to build the complete brand pull from the plumber's point of view. So all of that is happening, on a rigorous basis to get this business pulled up. I think, this is quite sustainable business. This is something that will need a lot of effort, but we are very tuned in. The management is regrouping itself in every way to make this happen in a big way.
Yeah, so what is the distributor as of now? Number of distributors? And what is our plan to add it in FY19?
So I said, every day we are introducing new distributors and retailers. We are going right up to the plumbers level. If you're asking the number of distributors, I'm sorry, I don't have that number at this moment.
Sure. And all this, pipes and fittings product would be sell through retail channel only, or is there any institutional sales or project in which we are also supplying through distributor route?
I think I've mentioned to you, so it will be both through the MEP consultants for the B2B as well as B2C through the distributors. Definitely this has its significance for big builders where they buy it in bulk as a B2B as well as through individual channels in the retail space for their requirements. So we are very much competent to go through both the routes.
Yeah. And my question was related to, overall business mix. If I was looking for of your, last 5 quarters EBIT margin for roofing and building solution, so it has consistently grew. And right now it is something around 15% for roofing business and 5% for building solution. Whereas your, revenue share is also changing. So with the change in product mix, what kind of, EBITDA margin that we are looking at blended level for the company as a whole, which was around something, 11.5% for FY18?
I think we are very conscious company on the profitability. I have absolutely no scope to let this company at all dilute its stance on the profitability. Any growth would continue to comply with the norms of profitable growth. And these are numbers that we have achieved, and we want to continue doing it no matter what the split is. There would be some ifs and buts in initially putting a business across, but as the business stabilizes, we will continue to get this or better results.
Yeah, so there is further scope for further improvement at EBITDA level, right?
Yes, Mr. Patel, you can expect the traction to continue.
Right, and my last question was related to, GST and e-way bill. I mean, any structural shift towards, branded organized product that you have seen? And you also mentioned that, GST rate has come down from 28 to 18%, which will, help us to, compete with unorganized players as well as other players. So, can you throw some light on that? And what is the pricing difference after GST cut as of now? Or we have taken, or pass it, the rate cut to our end users?
Mr. Patel, I think it was statutory on our part to pass on GSTs to customers, and we were very happy to do that. We were the first company in the industry to implement GST for all our modules, and from 2nd of July onwards, we were live on GST. We had taken enough steps to help our retailers, stockists also to get the GSTN number, and had a war-footing, team to support them in every direction. So we are very happy that this has happened, and we are very happy that we have taken the best benefit out of it. Definitely, this has supported the business, and we are very well-planned organization to work on that.
Sure. Thank you very much.
Thank you, Mr. Patel.
Thank you. Ladies and gentlemen, we will be taking the last question. That is from the line of Dipankar Sati from Maghad Capital Advisors. Please go ahead.
Thank you for the opportunity. Congratulations for the good set of number. Most of my questions have been answered. I was just, when I was looking the restated number versus the numbers that you have reported previously, there is some difference in that, around 40 crores per quarter or around 200 crores for FY17 when I'm talking about. So can you just help me understand what happened there?
If you can just a little bit clarify on what exactly, which line item are you talking about?
Revenue number, total revenue number. So for FY17, where previously we reported it was around 1,054 crores, and currently we reported around 1,245 crores.
This is, we clarified, I clarified in my note. Now we are in line with the Indians. We have regrouped the last year numbers also.
Okay.
SUT was part of the reporting. Now it has been classified with GST coming in. Yes.
Okay, and that impact was around 200 crores for that?
180 crores, yeah.
Okay, yeah. So it was mostly because of that changing of accounting standard?
Yes.
Yeah. Thank you very much.
Thank you very much for your comments as well.
Yeah.
Thank you. Ladies and gentlemen, that is the last question. I now hand the conference over to the management for the closing comments.
Thank you very much, Lizanne, and that was wonderfully executed by you. So it has been a pleasure interacting with all of you over this call. We thank you for taking time out and engaging with us today. We value your continued interest and support. If you have any further questions or would like to know anything more about your company, kindly reach our investor relationship desk. Thank you very much. Bye-bye.
Thank you all.